happen, the economic depression is come, very fast. They don't have time to announce the policies. Plus, you see that capital flight is going even in one day, right? You just need to online transaction and monies go out. But if you announce a policy takes 1.5 years to implement, right? So you need to match this gap. So they make this kind of stuff a little bit tough for the investors to try to take back their money and go back to the country. That's why right now you heard that the biggest corporations are leaving the China. It's not like one day game. They announce their withdrawal and it takes 5 years or 3 years. Like Samsung, it takes 3 years to go back from China. So they have announced that, okay, they are going back. So Toshiba, they have announced already 3 years back that they are going back from China. They are establishing, big gigafactories in Bangladesh and Vietnam. So it's not a one-time game. If you want to back your, flight of capital, then it takes time. Even if the Apple announces, even they are legal company, they are paying taxes, everything is going. If they announce that, okay, we are rolling back from China, it's not going to be happen in one day. Okay, why? Because government wants them to stay here because there are a lot of job opportunities, a lot of tax benefit and all those stuff. So they make it a little bit hard for them so that they can think twice, thrice that, okay, staying in China is going to be profitable for us. So maybe they make some policies for Apple companies, relaxation for taxation, this kind of stuff. But if they announce, if they make a deal, something, some political pressure or something, if they have to leave, then it's not going to be easy process. Right, guys? Florian, understand? Okay, so let's talk about this one. So under these conditions, they can invest funds to establish their operations in a country while that country's currency is relatively cheap. Then earnings from new operation can periodically converted back to firm's currency at a more favorable exchange rate. Simple, right? That I explained. So as an investor, like short-term investor, you invest in that country where exchange rate is about to increase. So you save the money with the banks, you receive interest. After receiving the interest, you throw back all the money to your own country and receiving two gains. One is from currency exchange gain. Number two is through interest exchange gain. Right? Now, factors affecting international portfolio investments. So like I told you, there are there are three ways you can invest in a country. That the foreign direct investment can happen in three ways. Number one, you start investing in their stock market, you start acquiring local companies, and then you finally go to have a company, physical company, you establish your own, right? So merger and acquisition is second stage. Third, you maintain your own company. First stage is international portfolio investment. You start investing in banks, in stock market, right? So factors that affect, So factors that affect international portfolio investment. Why we are writing international? Because at least two countries are involved. That's why we are using this international word. First of all, tax rate on interest or dividend. So that country who has less taxes, they will receive more inflow of capital from outside world. Interest rates, that countries over there interest rates are high, right? Our interest rates are high. Plus, currency is not going to weaken. They will receive more capital flow, right? If I'm here in Pakistan, I have, for example, $10,000, right? So I'm looking at that country on which, okay, in my country, I can receive 6% interest. If I see that, okay, in Bangladesh, they have 8% interest. So where I would save my money, or 8%. But I need to make sure that when I receive the interest, their currency is not weakened. If the currency is weakened by 3%, then I would be earning 3% because 3% is evaporated in conversion of currency, right? So at least stable or increase. If Bangladeshi currency is increased by 2%, I would be receiving 8% interest in Bangladesh plus 2% currency appreciation. So I would be earning 10% rather than if I invest in my own country and receive 6%. So I'm receiving 10%, right? So that's why the investment bankers, financial analysts, they have a crazy huge salaries. Did you see the Wolf of Wall Street movie? Anyone? The Wolf of Wall Street, this kind of like money markets films, please do that. And I do see that because they're gonna increase your canvas of thinking that how they are earning $3 million, $4 million in 2 or 3 months. How? Because they have $1 billion and they invest in that country for short term, their currency is going to be increased and they suck that money and it becomes 1.2 billion and they receive 5% or 10% as a bonus. And this is crazy money, right?
Uh, I know they can do this with their own money or they can do this with someone else's money. It depends on the agreement with the bank. And I just want to know, you cannot regulate this because it's like net profit which occur during to market fluctuation. So do you pay tax on this as well?
Yes, we pay taxes on that one as well. But the currency is going to appreciate too much. You don't pay taxes on currency appreciation. That's it. I have a dollar, I will send it to China, they will receive Chinese yuan. So there is no taxes, just there is some transaction fees. That's it.
Yeah, I got it. Understood. Okay.
Right? You just see transaction fees. So they have this arrangement, pre-arrangement. So there are some different strategies. We will see in our coming lectures. We will have some questions regarding that one as well. And then exchange rate. So that country receive more money where exchange rate is going to be strengthened. Now the questions start riddling in your mind. How I am going to earn more money in other country, the other country exchange rate is start going upward, right? So what's going to happen to that country? We just learned that their trade deficit going to increase if currency strengthen, and I'm going to be profiting with that one, right? The questions start riddling in your mind. Why? Because it's a chain reaction, right? So whenever the currency start appreciating, you take your money back. This is the best time to reap highest profit. Otherwise, because when currencies start going up, their exports start going down, and country is going into some kind of bad economic outlook, then there's going to be like some bad economic potentials. And what's going to happen? They reduce the taxes, or maybe they increase the taxes, and they put restriction on capital flight. So you need to think very carefully. When is the time to take back your money? Before the policy announced, because after policy you cannot take back your money. When you are eligible to take back your money, then currency start depreciation. Then you have a lot of losses with that one. So you need to be very, very vigilant about that. So that's why these investment bankers and all of them, they have different softwares, laptop with them, and they are traveling. They heard the news, they open their laptop and start doing transactions, right? Before the government announced some kind of blockage, they try to get back their money as quickly as possible. Okay, now impact of international capital flow. So now think in terms of countries' perspective. The United States relies heavily on foreign direct investment. Why? Because a lot of money is coming to the United States from other parts of the world, from companies, from governments, from as a loan, right? For example, if my company have nothing to do for 3 to 4 months, and we have $1 billion, so $1 billion is not going to be I'm not going to leaving that $1 billion in current account. I would be saving that $1 billion for 3 months. After that, I would be using that money. So I would look, I would give tasks to a CFO, the chief financial officers, who are responsible for money management, right? So they will look for, the availability of their, availability of money after 3 months. So this 3 months gap, they have the excess money, they will save it with the bank and receive interest as well. Plus, I would be needing money after 3 months for $1 billion I don't have right now. So where we want to have, we want to gather this $1 billion with a minimum cost. Whether it is beneficial for us to borrow loan from our home country or from foreign country, or which part of the country who is ready to give us $1 billion at minimum interest rate. So that's the impact that we are going to discuss today. So US manufacturing plants, offices, and other buildings, debt securities, US treasuries. So this book is basically US centric. So if you are studying the book chapters or studying this slide, think of yourself that you are a US citizen. Then it will, more clarify your knowledge. And then if you want to apply that knowledge, then think of yourself as your home country owner, and then you can extrapolate on your, on the basis of this knowledge. So US, we know that rely heavily on foreign direct investments. So investment in the form of people are investing in manufacturing plants, offices, buildings, right? Real estate. Plus, people are giving loans to the US firms. Plus, people are giving, or countries are giving loan to the US government, right? So, go back, or I think I'm going to give you a little tip, just for your curiosity. Go to the Google and just search that how much US government owe, or debt to Chinese. It's in trillions of dollars. I think more than $2 trillion. The US government has took the loan from Chinese government, I think more than $2 trillion from China. And it needs to be paid back to the Chinese, right? If they are not paying back, we are paying the interest. So it's just curiosity for you guys. Just log on Google and just try to search. You will be amazed. So foreign investors are especially attracted to US financial markets when the interest rates are in their home countries is substantially lower than the United States. So why these foreign governments and foreign countries, foreign companies, foreign people, they want to send the money to the US? Why? Because over there interest rate is good, right? So that's why they are sending the money. Despite the US exports are going down, countries' financials are not very good, but look at the financial markets are very, very strong over there. So they are sending the money to their financial system, pumping their financial system to go up. And that financial system is contributing hefty amount or heavily on US economy. So here we go. So recall our discussion of economics of demand and supply. So impact of international flow of funds on US interest rates and business investments. So we have amounts of funds that are available for business investments, and here are the long-term interest rates, right? So this is the demand of funds and this is the supply of funds, right? So if we are right now here,